Whether you're a beginner investor or just want to make sure your strategy is right for your goals, I've got a 12-month plan for everything you need to invest. In this video, I'll show you 6 investments to add to your portfolio and exactly how much to deposit every single month to reach your goals. We're talking investing for beginners today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, last Wednesday's video starting our 12-month investing plan instantly became one of the most popular on the channel, and we're bringing it home with today's video. Even if you haven't seen that first part of the Start Investing plan yet, watch this one because it's going to be taking you into 6 more must-see investments to get you to that $1,000 portfolio. I'll leave a link in the video description below and the first comment to that first video setting all this up and giving you that first 6-month strategy. And this is all coming from a poll we did a few months back revealing that 1 in 5 people in the community haven't started investing yet, and then half have been investing for less than a year. I know personally how intimidating it can be to start investing, putting your money to work. I started in 1999 with my first duty station in the Marine Corps, and I had no idea what I was doing. Now with the internet, it's almost like there's too much information, so I'm putting this 2-video series together just to show you exactly how to start investing. I'm going to take you from zero to $1,000 portfolio, show you how to get started, and give you everything you need to meet your financial dreams. By the time you're done, at the end of this year, you'll have that $1,000 portfolio, and just look at this graphic for what that can mean. If you've never invested anything else, that $1,000 can grow to over 20 times your money over 40 years. So let's get started because I am excited to share this strategy and show what it can mean for everyone in the nation that wants to get started investing. If you're not investing yet and you're worried about maybe finding the money to get started, I put together a monthly plan for how much to invest. You see here, we're starting low at just $50 in that first month. So maybe you go out to eat one less time or whatever you need to do. I want you to make that commitment and get that first $50 into your investment account. After that first month, we're going to increase it just very gradually so you're not stretching to pay the bills or just to enjoy your money. We're slowly creating that habit of finding a little bit more to invest until we get up to $100 a month. We're starting slower here because I want you to get into that habit of investing and not skimping to find the money. As I did in that first video, I'm linking to videos in the description below that's going to give you more detail on the topics that we cover in our 12-month plan. Just click through each one of these when you're ready for that complete course on how to invest in stocks. Investing into that second half of the year, we're first going to be looking at an investment that is too often neglected by investors: owning shares of foreign companies. Now, the old school of thought here was that you needed those shares of companies based internationally to get that faster growth in emerging markets and just to really separate your wealth a little bit from depending on the US economy. That's still important, and you just don't get enough of that from investing in big US companies with sales overseas. But there is also another reason that you absolutely cannot avoid foreign companies, and it could mean the difference between a portfolio that goes nowhere and one that jumps ahead over the next few decades. As we speak, the US dollar is being replaced as the reserve currency around the world. This chart shows the dollar share of global currency held in reserves, basically that safe money held by foreign governments. And other than a bump in the strength around 2013, you can follow that line all the way down from 72% in 2000 to just 62% today. Now, we don't have to get deep into the economics of all this to see what's going to happen. Those US dollar reserves held by other companies, it's not actually in hard cash, but in US Treasury debt. Essentially, the fact that the dollar is the most stable and trusted currency in the world means that foreign governments have been bankrolling massive US borrowings for decades. As this unwinds, as foreign governments put more of their reserves in gold and other currencies like the Chinese yuan, we are going to see less demand for US treasuries. That's going to push the interest rates higher here in the United States. It's going to mean less negotiating power in trade deals. It's going to mean a major economic revolution on a global stage. And as we watch all of this play out, not only are we going to see higher interest rates that are going to limit US economic growth, we'll also see a weaker dollar against these other currencies. That's going to make those shares of foreign companies more valuable and just amplify those returns of that part of your portfolio. Getting those international stocks is actually really easy, and you can do this in 2 different ways. One is to buy shares of individual companies that trade on the US exchanges. So you've got companies like Alibaba, ticker BABA, which is like the Chinese Amazon, or you've got Finland-based Nokia, ticker NOK. Now, if you don't want to pick individual stocks, you can also buy funds that hold international stocks like the iShares China Large Cap ETF, that's ticker FXI, or the Vanguard Total International Stock ETF, ticker VXUS, which holds shares of companies in every region across the globe. Now, a couple more months of depositing $90 here in August, and this month I want you to look at healthcare stocks. Now, after you get through that first year of investing, you can set your monthly deposits at whatever you can afford. Remember, we set those first deposits low at $50 just to ease you into saving and investing. Really, anything over about $80 a month is going to get you to that $1,000 portfolio every single year. If you can save more and not have to skimp every penny, then by all means, save as much as you can. But you need to balance between saving for tomorrow and living for today. That's really what I'm trying to do here with this simple 12-month plan. Show you how to find an amount where you can save for the future without sacrificing your today. Healthcare is becoming a larger piece of the economy, and you need healthcare stocks not just as a part of your investing plan, but also as an insurance against the rising cost of your own healthcare. Those healthcare costs are ballooning far above the rate of inflation on other prices. Politicians talk a good game about lowering drug prices and other healthcare costs, but look at their record. Have they ever really done anything to bring down that trend to higher prices? The single best way to fight against that rise in healthcare costs is to own a piece of the profits. Own the companies that are collecting those higher healthcare costs. Now, this year, there are going to be a lot of headline risks around that election. Candidates on both sides of the aisle are going to be talking up some ambitious plans for reining in healthcare costs, and it could hit these shares on those headlines. Again, just look at their track record on both sides though. Regulatory change has never been as bad as expected, and I'd be a big buyer on any dips in healthcare. In September, we look at Warren Buffett's favorite stock sector, bank stocks and other financial companies. Now, to understand why bank stocks could be good investments this year, you have to know a little bit about how they make money. Now, banks borrow from their depositors, so every time you deposit money into a savings or a checking account, you're actually loaning the bank some money and getting paid in interest. Now, the bank takes this and loans it out for those longer term mortgages and other loans. So if you look at the yield curve, now that's the graph of the current interest rates on loans at different time lengths, you see that this setup is usually very profitable for banks. Pay depositors maybe a % annual rate and then collect 5 or 6% from mortgage borrowers. Now, around the middle of last year, that yield curve actually inverted, where rates on short-term loans of 2 years were higher than the rates charged on 10-year loans. Now, not only is this a bad signal for the economy, but banks obviously can't make any money if there's no difference between the rates that they pay and what they collect. And you saw the effect here on the SPDR S&P Regional Banking ETF, that's ticker KRE, through much of last year. Bank stocks bounced around between highs on a fairly good economy to those worries on profitability and rates, and pretty much went nowhere until the yield curve steepened again with those longer-term rates in October. Now it looks like those longer-term rates have recovered for good, and the consensus is for further steepening of that yield curve through 2020. The Fed is probably not going to be cutting or raising rates, and inflation is looking to pick up just a little bit. The economy is doing pretty much okay, and this should all mean that those long-term rates continue to tick a little bit higher, which should mean better profits for the banks. October is our first month of depositing $95, and we're putting it to work in some exciting stocks here. Those are the fastest growing companies. Now, we talked about finding value stocks in the January part of our plan in that first video, and this was really going to be the other side of that coin. Growth stocks are companies with faster sales and earnings growth, often with the stock price rising much faster than the market, and these shares are usually going to be relatively more expensive. That's a problem for a lot of investors, those higher price to earnings ratios. The example we used in our value stocks was for Netflix, which trades at a price of over 100 times the earnings it makes, versus Disney, which trades for just 25 times its profits. But a look at the stock chart for Netflix and Disney, and it becomes painfully clear to the value investor that growth stocks need to be a part of your portfolio. Even though Netflix constantly trades that ridiculous PE ratio, it's managed to keep up that faster growth, and the shares have surged almost six-fold over the last 5 years. And towards the end of October is the perfect time to start thinking about these growth stocks, because we're heading into what typically is the best months for investors. And remember that chart of the average monthly stock returns, and we see that November through January are the 3 of the best months. So investors are coming back into stocks after the summer. The stock market is rising, and that's going to be a positive catalyst for a lot of these growth names. A lot of the return on growth stocks is because of that market sentiment. How optimistic are investors? How willing are they to pay these huge premiums like 100 times earnings for a stock? When you get that rising market sentiment like you generally see in that November through January period, That's always going to be a good time to invest in these growth stocks. For the November plan, I want to move to talking a little bit more about strategy and making investing easy with funds and the core satellite approach. Those of you in the nation have heard me talk about the core satellite strategy before. It's a strategy I use, and it's perfect for the investor that wants a little bit higher return but doesn't have all day to analyze stocks. Now, the core satellite strategy is where you put 60 to 75% of your money into broad funds or ETFs. We're talking about funds that cover the asset classes like stocks, bonds, and real estate. Maybe you invest in a fund of dividend stocks or maybe even international companies. Now, these funds are going to give you those market returns that diversify your portfolio for that smoother ride. Then you take the rest, that 25% or so of your money, and invest in a small handful of individual stocks, maybe 7 to 12 stocks. By limiting your portfolio to less than a dozen stocks, you solve a lot of the problems that lose investors money. You're not constantly looking for new stock picks. That's going to save you hours. Plus, it means you'll only be investing in the very best stocks you find. It makes it much more practical to keep up with your stocks as well, keeping up with the research on where a company is going. That's something you just can't do if you're investing in 20 or 30 or more companies. Now, how this fits with our larger 12-month plan is you can invest in a fund, an ETF that covers some of the themes that we've talked about, like healthcare stocks, tech, or growth stocks. Then you go through those themes and pick out maybe 1 or 2 individual stocks you really like. Maybe you pick one healthcare stock you really like, or maybe 1 or 2 tech stocks at the most. This is going to give you that diversified portfolio covering all the pieces of the economy, so you get those market returns, but also the opportunity to have those higher returns on those individual stocks. Now, I know a lot of you are hesitant or against investing in this next sector, but I want you to look at stocks of energy companies in December. The energy stocks video was the single most controversial video in our stock sector series. I heard from a lot of you in the nation that you either didn't want to invest in the sector or just felt that its days were numbered with the rise of electric vehicles. I still think this is a sector you need to have in your portfolio though. Energy is the only sector in 11 to trade below its long-term PE multiple. The only sector to trade at a discount when the rest of the market is 20 or 30% more expensive than that long-term average. Now, the stocks in the group pay some of the best dividend yields, some upwards of 7 to 10%. Global oil demand grew by over 2 million barrels a day over the last 2 years. That's just the growth in demand. Globally, more than 100 million barrels of crude oil and these other energy products are used every single day. Maybe someday we'll all be driving around in our little electric buggies, but it's not going to be happening in the next 5 years. Even as that shift develops, though, demand growth for 1 million barrels a day doesn't stop overnight. Do not avoid shares of energy stocks on that idea that the alternative fuels are going to be pushing out that demand. Click on the video to the right for the first 6 months of our plan, how to set this all up and how to start investing today. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.